Hello friends, welcome to the video on foreign exchange market. This is Dr. Shabir KP. Thank you for your company. In this video, we will elaborate the meaning of foreign exchange market, important participants in the foreign exchange market, main functions of forex market, the concept of exchange rate, how these exchange rates are actually determined, and different type of exchange rate adjustment policy. We'll start from the meaning of foreign exchange market. It's a worldwide market and institutions that handle the exchange of foreign currencies. It's a market in which there is buying and selling of foreign currencies, or what we call the foreign exchange. It's an organizational framework within which different participants buy and sell foreign currencies. The largest foreign exchange market is the London foreign exchange market, and other important markets are New York, Tokyo, Singapore, and Frankfurt. The most heavily traded foreign currency is US dollar, which is sometimes also called the vehicle currency because it is used to denominate most of the international transaction, if not all. From here, we are moving towards the main participants in the foreign exchange market. And these are the important participants: the commercial banks, business corporation, non-banking financial intermediaries or institutions, and we obviously have the central bank. As far as commercial banks are concerned, they are at the center of the foreign exchange market because almost all sizable international transactions involve debiting and crediting the accounts of commercial banks at various financial centers. Commercial banks routinely enter into the foreign exchange market to meet the needs of their customers, particularly the business corporations. Often, the commercial banks also quote other banks' exchange rate at which it is willing to buy and sell currencies. The foreign currency trading among banks, most of them call them as interbank trading, accounts most of the activities of the foreign exchange market. Thus, commercial banks act as clearing houses between the users and earners of foreign exchange market. Then we have the business corporations, the large business corporations who are involved in international business. By international business, we mean the business activities that crosses national boundaries, even though it is located in a home country. If it is earning income or incurring expenses in any outside country, you are involved in international business. So corporations, business corporations which have operation in several countries obviously will frequently receive payments and currencies in more than one currency. The third comes the non-banking financial institutions like insurance companies, asset management firms, chit companies, mutual funds. In the recent years, the deregulations in the financial market in a number of countries have encouraged non-banking financial institutions to offer their customers a broad range of services, and most often they are indistinguishable from those offered by commercial banks. Among these services, it also involves the foreign exchange transactions. The fourth one, and perhaps the most important one, is the central bank. The central bank of the country acts as a seller or buyer of the last resort when the country's total forex earnings and expenditures are unequal. Even though the volume of central bank's transaction may not be typically large, but their impact may be very great. This is the reason that all other participants looks closely the activities of the central bank, because it provides clues about the future macroeconomic policies that will obviously affect the exchange rate. From these four participants, we are moving towards the main functions of the foreign exchange market. To start with, it must be said that the need of the foreign exchange market arises because international trade in goods and services almost obviously involves dealing with different currencies. If the world is having only one currency, there would not have been any need of a foreign exchange market. Now, obviously, perhaps the most important function of foreign exchange market is the transfer of funds or purchasing power from one currency to another or from one country to another. The second function is the credit function, because credit is usually needed when commodities are in transit. In general, the exporter will allow around 90 days period for the importer to pay. However, the exporter can usually discount his importer's obligation in a forex department of any commercial banks. As a result, the exporter will immediately receive the money and the bank will eventually collect this payment from the importer when it is due. Thus, in general, the foreign exchange department of the commercial bank extends credit or it finances international trade. The third one is it provides the facilities of hedging and speculation. Hedging and speculation is related to the foreign exchange risk. By foreign exchange risk, we mean the fluctuations in the value of asset, liabilities, income or expenditure as a result of an unanticipated changes in exchange rate. That means when exchange rate changes, an open exchange rate or a flexible exchange rate often changes minute by minute, day by day. It obviously involves differing or changes in the asset, income, liabilities or expenditure. So whenever our future payments, receipts involve foreign currencies, we will face the foreign exchange risk. And some people will try to avoid this foreign exchange risk. This activity is known as hedging. While some people will accept the foreign exchange risk to make a profit out of it, it is known as speculation. So, foreign exchange market, most importantly, the forward foreign exchange market. We will elaborate the nature of spot, forward, option, future in another video. The forward foreign exchange market, which is a part of the foreign exchange market, provide facilities of hedging as well as speculation. So these three are the important functions of the foreign exchange market. Now, we shift our focus to the meaning of exchange rate. Like, as we said, foreign exchange market involves buying and selling of currencies. Obviously, the most important determinant will be the exchange rate. Exchange rate, simply stated, it is a price of one currency in terms of another. But since there is an essential symmetry between two currencies, exchange rate may be defined in two ways. One, the cost in domestic currency of purchasing one unit of foreign currency. To put it in simple words, it is the amount of domestic currency required to purchase one unit of foreign currency. Second, it is the amount of foreign currency that may be bought for one unit of domestic currency. That is, the amount of foreign currency that can be purchased with one unit of domestic currency. Obviously, the second method is the reciprocal of the first method. Usually in economic literature, we use the first method. That is, by exchange rate, now onwards, we define that it is the amount of domestic currency required to purchase one unit of foreign currency. Now, this definition of exchange rate corresponds to what is known as nominal exchange rate. But there are other concepts of exchange rate as well, namely the real exchange rate, the effective exchange rate, and there are two types of effective exchange rate, the nominal effective exchange rate known as NEER, as well as real effective exchange rate REER. We'll start from the real exchange rate. The real exchange rate is the nominal exchange rate adjusted to relative prices between countries under consideration. That is, SR, which is the real exchange rate, is equal to S into P by P star. P is the domestic price level, P star is the foreign price level. Here, the S, which represents the nominal exchange rate, is defined as the foreign currency per unit of the domestic currency. That means we use the second definition while measuring the real exchange rate. So real exchange rate is the nominal exchange rate adjusted to the price level between countries, or relative prices P by P star. From real exchange rate, we are moving towards the effective exchange rate. Effective exchange rate talks about one currency in terms of a number of currencies, or what we call a basket of currencies. These currencies are the currencies of those countries whom the country trades with each other. So basically, it is a weighted average of exchange rate between domestic currency and countries' most important trade partners. Being a weighted average, we have to calculate the weight. The weights are given by the relative importance of countries' trade with other trade partners. So most important trade partner will receive highest weight as far as currency is concerned while we measure the effective exchange rate. So basically, effective exchange rate provides a measure of whether a currency is appreciating or depreciating against a basket of currencies. Now we have two types of effective exchange rate. One, nominal effective exchange rate, which is an unadjusted weighted average of one currency with respect to a basket of currencies. Unadjusted means we are not considering the price movement. It's a weighted geometric average of nominal exchange rate of home currency in terms of a number of foreign currencies. When we also consider the price adjustment, price changes, price deflator, we have the real effective exchange rate. It's a measure of the value of currency against the weighted average of a number of foreign currencies divided by a price deflator. That is, it is adjusted to the ratio of domestic prices to foreign prices with nominal effective exchange rate. That is, we can always calculate the real effective exchange rate after calculating the nominal effective exchange rate. So, real effective exchange rate is nominal effective exchange rate adjusted to the relative price changes. Now, how exchange rates are actually determined? In the earlier definition, we saw that it's a price in terms of one currency into another. So, obviously, it will be determined in the market. It is determined like any price of the commodity, like market forces of demand and supply. But there is a difference. Here, we are talking about currencies, not commodities. So, the factors that influence the demand and supply will differ. So demand for foreign currency arises when we want to purchase commodities from abroad, we want to purchase services from abroad, or more simply stated, we want to import from abroad, or we want to make a unilateral transfers, we want to purchase financial asset, we want to make investment in the foreign country, if we want to avoid losses or make profit out of it. Now, how supply of foreign currency comes up? When foreigners purchase our commodities or as a result of our export earnings, when there is unilateral transfers, when foreigners make foreign investment in our country in the form of foreign direct investment, foreign portfolio investment, foreign institutional investment, and purchase of home currency to avoid losses or to make profit. The foreign exchange market brings together those people who want to or who wish to buy the currency with those who want to sell the currency. That is, exchange rate is determined by the demand and supply factors. Now, it's simply a downward sloping demand curve, an upward sloping supply curve, and this figure represents the determination of exchange rate from an Indian perspective. That means we are considering the exchange rate between Indian rupee as well as US dollar. In the horizontal axis, we measure the quantity of dollar. In the vertical axis, we measure the exchange rate as per the first definition, that is the amount of domestic currency required to purchase 1 unit of foreign currency. Downward sloping demand curve and upward sloping supply curve intersect at point where exchange rate is equal to E star and quantity of dollar is equal to Q star. Now let us suppose that there is an increase in demand for dollar. We shift the demand curve towards the right, D dash, D dash. Supply curve remaining unchanged. The new exchange rate will be at E dash. Now, an increase in the demand for dollar leads to an increase in exchange rate, or there is an appreciation in the value of dollar. On the contrary, it also means that there is a depreciation in the value of domestic currency, which is in our example is Indian rupee. One point needs to be remembered here. An appreciation and depreciation take place as a result of changes in market forces alone. When the same thing happens as a result of a deliberate interference and influence from the part of the monetary authority, we call it as revaluation and devaluation. So here it is an appreciation in the value of dollar as a result of an increase in the demand for dollar. Now let us explore another possibility. The demand curve remains the same. There is an increase in the quantity of dollar as the supply curve shifts to S dash S dash. Demand remains in the same. Quantity of dollar increases. Then there will be a decline in exchange rate, or in other words, there is a depreciation in the value of US dollar or an appreciation in the value of Indian rupee. So depreciation as well as appreciation took place as a result of changes in market forces, while devaluation and revaluation took place as a result of influence by the central monetary authority. Now we are shifting our focus to exchange rate adjustment policy. Broadly speaking, there are two broad regimes of exchange rate. One, the fixed exchange rate, the other, the flexible exchange rate. Fixed exchange rate is also known as pegged exchange rate. Flexible exchange rate is also known as floating exchange rate. But there are certain exchange rate which we call it as hybrid or intermediate exchange rate that lies or that have the features of both fixed and flexible. Without the theoretical possibility of fixed as well as flexible, we will also explore the nature of hybrid or intermediate exchange rate. We'll start from the fixed exchange rate. As we said, it's also called pegged exchange rate. In the fixed exchange rate system, each country fixes its exchange rate against other currencies of the world. And the central monetary authority constantly intervene in the foreign exchange market by buying and selling currencies to avoid any day-to-day fluctuations in the exchange rate. So there will not be any day-to-day fluctuation, even though very small margins of fluctuation around the pegged value or par value may be allowed. So there will not be any uncertainty. Exchange rate will remain unchanged. It will remain as fixed. It's also called, as we said, it's a pegged exchange rate. In the flexible exchange rate, there is no intervention from the part of the monetary authority. It's a floating exchange rate. Exchange rate will be allowed to vary whenever there are changes in the fluctuations or whenever there are changes in the demand and supply of the currency. It is completely free to vary, and market clearing will take place as a result of automatic adjustment in the demand and supply. It's called flexible exchange rates. So these two, fixed as well as flexible exchange rates, are two extremes of exchange rate adjustment policy. Now we are shifting our focus to the hybrid exchange rate system, or what is known as the intermediate exchange rate system. Managed floating, sometimes also called controlled floating, in which monetary authority intervene in the exchange rate market to smooth out any short-run fluctuations in the exchange rate. So basically exchange rates are determined by the market. But when it is needed to be intervened, needed to be adjusted, central monetary authority will intervene. That is why it is also called a dirty float. It's a policy of leaning against the wind. If the monetary authority frequently intervene, it's also called a filthy float. Adjustable peg system is basically a fixed exchange rate system. That is, exchange rate is picked or fixed for a period of time until there is a fundamental disequilibrium in balance of payment, and once the country's foreign exchange reserves are exhausted, then the exchange rate will be adjusted or repegged at a lower or higher exchange rate system. So the changes will be substantial. In the case of adjustable peg system, it will remain fixed until a fundamental disequilibrium in balance of payment emerges. Crawling peg system. In the crawling peg exchange rate system, the monetary authority will intervene in regular intervals by making small changes or small intervention. That is why it's sometimes also called a gliding parity system or trotting peg system. Monetary authority adjusts at regular intervals by small amounts, which avoids the possibility of making large devaluation or revaluation. So there is a gradual adjustment in the case of crawling peg system. The exchange rate band is basically a system in which currency is allowed to fluctuate between an upper and lower band or upper and lower exchange rate. The exchange rate will not be allowed to move outside the band. The countries can fix a wide band as well as a narrow band. The monetary authority will intervene only when the exchange rate hits the ceiling of the band, either the upper ceiling or a lower ceiling. When we have a band within band, like in the case of 6 countries of European Economic Community who followed a system in which their currencies were allowed to fluctuate within 2.25% band related to that of 4.5% related to other countries of the world. We have a band within the band. In that system, in that type, we also call it as a snake in the tunnel. Now, in this video, we have examined the meaning of foreign exchange market. We saw that it's a worldwide network of markets and institutions that handle the foreign currencies. We saw the participants in the foreign exchange market like commercial banks, business corporation, non-banking financial institutions, central bank. We saw the functions of foreign exchange market like transfer of purchasing power, like credit creation, provide facilities for hedging and speculation. We saw different concept of exchange rate like nominal exchange rate, real exchange rate, effective exchange rates. We saw how exchange rates are determined. Different exchange rate adjustment policy like fixed, flexible, hybrid exchange rate system was also seen. Hope that this video is useful to you. For additional clarification and handout, you can always visit our blog skpeco.blogspot.com.